So I get a lot of questions around what's the Fed going to do. We obviously have an upcoming Fed meeting, but in this era of fiscal dominance, I pay a lot more attention to some of these other factors. Even though, of course, Fed decisions still matter, but at the end of the day, fiscal matters a lot more. In quarter three, window dressing, and then it wasn't really tapped in quarter four, but we saw kind of initial funding stress leading up to it. Basically, it was expensive for different institutions to get the liquidity they needed during window dressing. If we take the TGA out for a second, we probably should expect that by mid-year or so, we run into some pretty serious liquidity constraints in the system. We'll get kind of updates probably each quarter to see what does funding stress look like. Did anyone have to tap the repo facility, the Fed's repo facility, and things like that? But with Powell's remarks about how he can't be forced to leave, during Trump's prior term, he was sometimes critical of hawkishness out of Powell, and so instead of rates, we could see a debate over liquidity, essentially balance sheet size, and the Fed kind of offsetting some of that duration issuance. Without Fed support, the risk is that as they try to increase duration, that would suck liquidity out of the system, and that potentially threatens asset prices. And even compared to most other, I mean, all presidents care about the stock market and asset prices, but Trump especially looks at those. And so if owners and the non-asset owners, because anyone who entered this period with a lot of assets and with a home, either that they own outright or with a fixed rate mortgage on it, they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that fiscal deficits, and raising interest rates doesn't do anything against monetized fiscal deficits. Now they can push back on monetizing it to some degree, but at the end of the day, if they see dysfunction in the treasury market, they always step in to fix it. Um, and so their tools are not really geared around that, and that's why it's ultimately more of a fiscal thing. Now the Fed they can kind of indirectly tackle that by saying, well, if fiscal is running hot and is therefore contributing to inflation, we can run bank lending at below average to try to offset it. We can say, okay, if bank lending is per capita is at the highest in the world without really good outcomes to show for it, defense is all sorts of geopolitical issues, but also tons of fat that they could cut out, but is very entrenched. I think that like the main moving parts there are if we had gotten a Harris victory, then we would have had to more seriously consider some of those Trump era tax cuts expiring, going back into effect, which would have been effectively a tax increase. Now, because we get the Trump victory, those are less likely to be allowed to go back in. They're more likely to be either a little bit more of like kind of socially conservative but fiscally more moderate kind of Republican Party that we see, because that's a very strong voter base is people that receive those benefits. So a lot of that is locked in very, very kind of the third rail to go after. Interest expense is obviously very hard to go after. DoD is a potentially big area to cut. But every one of those programs is going to have whatever congressperson has that in their district fighting for it. And so that's, 5% a year monetized fiscal deficits, and then you're reducing corporate and private debt by 2% a year. You're left with like 3% net growth, which is low. And so that's kind of the situation Japan went through. It's harder in the U.S. because we're running structural trade deficits. So our currency, could have more issue with kind of perpetually zero rates when other major currency blocks are not at zero. The funny thing is it would then probably allow other by 3 million barrels. I think it'll be challenging. And the reason for that is I think most of the current kind of like stagnation in US oil output is more a matter of corporate decisions, and then also well depletion rates, more so than just the Biden administration. So the Biden administration was actually more bark than bite on energy. So they had a lot of initially campaign targeting against hydrocarbons, but then when inflation hit, they were, their actions were actually not very petroleum reserve to kind of offset that. You could get flat energy prices despite an
Yeah.
uptick in production. But they would at least say, okay, we refilled it. We're more prepared for an emergency than we were before. I do think in general we're going to see more non-market things. That's kind of a hallmark of fiscal dominance. I mean, even just the fact that deficits exceed net new bank loans in a given year, which is what we're experiencing now, but we did not experience usually outside of recessions in our lifetimes. Thing like in terms of economy and tech, they don't have they've lost a lot of their energy security. They don't really have the tech. We've seen gradual deindustrialization in Germany. Um, and that's a really big component of the dollar index. So when I look at kind of dollar wrecking ball, I'm looking at mainly like other currency pairs outside of the euro. So dollar to Chinese currency, dollar to Brazilian currency, and those are kind of levels that I'm watching. And one of the factors of one of the things, and then therefore it boosts our import power and hurts our low margin export competitiveness, which especially hurts manufacturing and those kind of areas. And so dollars just kind of pour out into the world. If we start aggressively trying to shrink our trade deficit, we are indirectly saying that okay, we're not going to supply as many dollars anymore, and so that creates a few different scenarios. One is the world, even though they have a lot of dollar-denominated debt and a lot of liabilities for dollars, they also have a lot of dollar-denominated assets. So they can sell some U.S. assets to service their liabilities. So you can, and so they don't want a major devaluation relative to the dollar. And the dollar, if the U.S. wants to have more competitiveness on their imports, a weaker dollar can help with that. And so basically, it's you could say, look, I'm going to do a lot of tariffs and potentially mess up both of our economies, or let's come to the table and have like a some sort of 10 to 20% currency move. You can stimulate a little bit, weaken your that will weaken the dollar relative to you, and we'll do some optical tariffs that keep the narrative alive, but don't really kind of disrupt things, and that could give you a little bit of a global economic boost. There's basically two methods. One is you either have a more multipolar currency world, so you say, okay, so some reserves are in dollars, others are in euros, others are in Chinese yuan, and a couple other major ones, or excess reserves and storage are kind of held in gold or Bitcoin. Um, and now the problem is that the current, the upcoming Treasury Secretary has specifically said that they want to keep the dollar as the global reserve currency. They want that sanctionability, and I think that's where there's some competition. You say, well, we want to reduce the trade deficits, even though the trade deficits are what supply the world with dollars to be the world, and to some extent the broader crypto space. Um, if you start to get bigger and bigger with Bitcoin, then potentially starts to challenge gold more directly. Um, Probably not for quite a while. And then even in that scenario, kind of like how gold is always like seen as like the hedge against some sort of major economic issue, you could see gold as like the hedge against some sort of major cyber attack or something. People will, there'll still be entities around the world that say we want to have some analog wealth stored rather than, put every single thing on this network. So that it certainly still could be seen as like a backup option.